Guys, this morning started out pretty rough. I woke up, checked futures, and at that point, I actually thought it was an error. And the market, and NASDAQ was down over 4% pre-market. I checked it. I'm like, oh my God, this is real. It got to over 5% down pre-market. But here's what's interesting. It's now under 3% as of the recording of this video at 10:01 a.m. But look at this, guys. Here's what's interesting. Look at this. Apple's up. Look at all this red here on the big companies. But then look right here. A lot of green. A lot of green here. This is a heavily concentrated big fall for the NASDAQ. Now, obviously, it's driven by tech because of this deep think coming out of China. There's a lot of lessons to learn here, so stick with me in the video. I want to make sure I explain this for the long term. But before I get there, we've said before, the companies that really drive up a lot of the value, you get in these territories where a few companies drive it, those are going to be the companies that lead it down. You look at Nvidia, is down 11%. Now, the reason for today being down is deep think out of China is supposedly able to do a lot more AI for a lot less cost. And that's causing these companies to fall. So what's their learning lesson here? Well, like you've always said, if a company like Nvidia is that fragile because of that, that's what worries me about any sort of company going forward. Whenever there's a lot of hype and excitement, these things are going to fall because of the smallest cracks. By the way, do I think Nvidia is going away? Absolutely not. But Friday to today, Nvidia is down 11.3%. Really? Is that rational? I want you guys to remember this. When things are going up like crazy, yes, you could ride that tidal wave and you could ride it for a long time. But the second people have a reason to bail on the thesis, you're going to have problems, especially when prices are factoring in near perfection. And that's what I think was happening with a lot of these Mag 7 stocks. They were pricing practical perfection in. Isn't it weird that Apple's up 1.8%, Nvidia's down? Adobe. This is the company that I heard as I own some Adobe. Don't go buy a company just because I or anybody else on the internet or the world has done it. But everybody's telling me, Paul, you don't get it. Adobe's going to be completely obsolete because of AI. Maybe. What's interesting to me is you look at a company like Tesla, which I think is a car company still, only down 1.7%. Google's down 3.2%. A lot of red in the NASDAQ 100. But look at all this green here. Even AT&T is up 6.3%. They reported, and we'll get into that in another video. But look at all this green here. Look at all this green. Berkshire Hathaway. Remember when everybody said Cathie Wood was better than Warren Buffett? Remember that? That was funny. That was really funny. But of course, everybody said, well, Cathie Wood's got a hedge fund and blah, blah, blah. Guys, the stock market's frothy. We are in bubble territory. We have been. When will it burst? I have no idea. But it will burst and it will be ugly. This is not the first time this has happened. This will not be the last time this has happened. But I want you to learn this as you go forward. Doesn't mean you pull out of stocks. It means you have to be more careful when buying individual stocks. And if you dollar cost average in a low cost ETFs, which everybody should, including myself, and I do that, what I want you to remember is the future is not going to be as bright as this recent past. And that's okay. Because as the markets fall, your job is to dollar cost average in at lower prices. Now, how expensive are stocks right now? Well, let me show you guys. This is my stock market to GDP ratio. As of the second, the S&P was at 6,005, 116% overvalued. Now you might sit there and say, Paul, GDP doesn't matter because so much money is made overseas, blah, 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 blah. Give me a break, guys. This is the single most reliable metric on stock market valuations at any given moment. As the world's best investor, that dinosaur named Warren Buffett has said, it's expensive. And guys, I've seen the comments. Paul, this is an old metric. Why do you care? Well, you guys always forget about the second metric I always talk about then. The 10-year cyclically adjusted PE ratio. And by the way, when I hear people say pick a new metric, it makes me feel good inside. It actually does. It makes me say that's people's way of saying it's different this time. Yes, they're not uttering those words, but when they say this metric right here is old, it means it's different this time. But what about the 10-year cyclically adjusted PE ratio? It just takes the earnings of the S&P for the last 10 years, brings it to today. All the earnings, doesn't matter where it's earned, we're at 38.47, 124% overvalued. Great. I will stop talking about the stock market GDP ratio. This is worse. This is worse. Guys, at the end of the day, when you buy an investment, the more you pay for it, the less return you're going to make. The less you pay for it, the more return you're going to make. Why? Because when you lay out cash for an investment, your return is going to be based on the cash flows you receive in the future. I say it 1,000 times. Every investment is the present value of all future cash flows. What that means is when you make an investment, if you take all the future cash you're going to receive from it and bring it to today, that will be your return. You present value it all to today. So the more you pay, the less that money is going to be worth. For example, if I told you your cash for the next 5 years is $1 a year, $5, if you pay $1 for that, you're going to do pretty well. You're going to get $5 over the next 5 years when you laid out $1. If you pay $10 for that, you're going to do pretty poorly. That's the point. Every investment's the present value of all those future cash to today. But the more you lay out today, the less your return is going to be. So I get it. That metrics is so boring. But guess what? Good investing is boring. That's what I love about investing. Great investing is boring. You don't need to be the person who's analyzing tons of Excel sheets, all that stuff. Just pick a good company. Figure out if you can figure out a way to determine their future cash, put in your margin of safety. And if you can pay less than that today across a myriad of companies, you'll probably do pretty well. The same thing happens with the entire stock market. If the S&P today were selling for 2,000, do you think the next 10 years would look good or bad as a return? It'd look amazing. And you might sit there and say, well, Paul, if the S&P was at 2,000, I would back the truck up. Easy to say that. And we'll be here to help you do that. But you know what's going to happen if the S&P was at 2,000 today? The world would look terrible. The stories would be terrible. All these things would be terrible about the future. And that's what would make the S&P sell for 2,000 today. That's what's important to understand. It's not that the future is actually terrible. It's the perception. That's what would make the stocks fall to 2,000 or whatever number it'd be. Even if it was only to 4,000, the story would have to be bad. That's what always happens. News follows the stock price. And if you don't believe me, do me a favor. Mark this on your calendar. Sit there and if you're a part of our community, put a watch list on S&P for SPY and QQQ, put a much lower price, 30 or 40% from now. Go take screenshots of the articles right now on the internet, and then wait to see what it says then. We got to get to the point where people say you cannot buy stocks. That's what will get us to a new secular bull market, a long-term bull market. We got a ways to go for that one. I don't know how it's going to look. The history doesn't repeat itself, but it sure does rhyme. So yes, it's boring to see the S&P 500 stock market to GDP ratio. It's boring to see the cyclically adjusted PE ratio. That's another form of it's different this time. And guess what, guys? It's not. Because money is money. And you lay out money today, the return is going to be X. You can get 4.3% on a 90-day treasury right now. So what do your returns have to be in the stock market to justify that sacrifice? That's the question. And in the time since I started this video, the S&P is now only down 2.6%. What's interesting is the Dow is almost even. Why? Because it doesn't have Nvidia, it doesn't have some big players in there. So if this is the start of something big, stick with the channel. If it's not the start of something big, stick with the channel. You'll learn better about buying individual stocks and dollar cost averaging the low ETFs. Thank you for your time.